Hello, everyone, and welcome to a market forecast brought to you by Westcal Financial for 2022. First, we'll start off with a quick recap from 2021. In the beginning of the year, we thought that interest rates would begin to rise, and they did. But they did rise sharply in March as anticipated, but recovered a bit earlier than we expected, gaining back most of the losses by late summer. For housing, with strong demand and tight supply, we anticipated at least high single-digit percentage home value increases. But in actuality, the strong demand and tight supply, but also the COVID supply chain distributions and labor shortages pushed real estate values even higher than our robust forecasts with, I believe, 18% home value appreciation roughly across the nation. There's the Fed that's going to play a major role in 2022. There's tapering already taking place, rate hikes that will follow soon after, and balance sheet runoff. This can have a strong impact in equity markets, drive interest rates, impact housing as well as jobs. Some of the Fed voting members rotate each year, and in 2022, the composition will be less accommodative than in 2021. Fighting inflation will be their main focus. Negative stock market reaction could cause the Fed to lose resolve. The Fed should have hiked sooner, mistakenly thought inflation was transitory, as we've heard many times now. And history can help us forecast how the Fed's actions in 2022 will influence the markets. So here's a little history lesson. We've got Arthur Burns in the 1970s. Burns was Fed chair. He ignored inflation, which was rising rapidly. Instead, he insisted inflation was transitory. Does that sound familiar? We've heard that many times now. Year-over-year inflation ballooned from 7% in 78 to 14% by the time he left in 1980. Burns remained steadfast that inflation was transient. Higher inflation caused mortgage rates to rise from 12 to 18%. Then along came Paul Volcker. Fighting inflation was his main focus. He hiked the federal funds rate from 11% to 20% in just 2 years. Inflation dropped quite rapidly from 14 down to 5. But because inflation dropped, mortgage rates sharply declined from 18% down towards about 12%. But there were consequences. The S&P 500 sharply declined by 30% during this time. Tight monetary policy pushed the U.S. into recession in 1982. Then along came Alan Greenspan. In the late 1990s, inflation doubled from 1.75 to 3.5%. Higher inflation caused mortgage rates again to rise from 7% to 8.5%. But unlike Burns, Greenspan took action in 1999 and hiked the federal funds rate by 1.5%, matching the rise in inflation from 4.75 to 6.5% in a year. Inflation responded and dropped from 3.5% to 1%, kind of a similar theme. Mortgage rates dropped from 8.5 down to 5.5, sparking a huge refi boom. But then again, there was also the consequences. The S&P fell by S&P 500 fell by 50% from the spring to fall of 2000, and once again, the U.S. entered into a recession in 2001. Today, under Jeremy Powell, we've got 2021 inflation increase from 1.75 to 7%. Powell thought transitory. Again, this is a common theme, the word we've been hearing all along, and it's not the case. It's sticking. Higher inflation caused mortgage rates to rise from about 2.5% to nearly 3.375%. The Fed is currently tapering, trying to address inflation, the purchase of mortgage bonds and treasuries, but they will not hike and reduce purchases at the same time. Once done tapering in March, likely they will start to hike the federal funds rate in May. Fed's targeting 3 rate hikes in 2022 and 2 or 3 more in 2023. inflation and interest rates can still rise until the Fed acts. So in the short run, we're probably going to see rates continue to rise as they slowly address inflation. If the Fed can tame inflation, mortgage rates should drop, but maybe from higher levels than we currently sit at. Here's basically a recap or a pattern over the years of the Fed addressing inflation and what subsequently happened to mortgage rates when the federal funds rate was increased, and the inflation response, as well as what mortgage rates dipped in response to the federal funds rate increasing. The consequence of that, and the part that they have to delicately balance, is a stock market sell-off. So they are doing their best, but are normally a little late to the game when it comes to addressing inflation. And if they go too much too fast, it could definitely have an impact to the stock market. And so with that said, wild cards that are at play, you've got COVID plays a major influence on monetary policy and supply chains. Major surprise in COVID could change the outlook dramatically. Additional stimulus may fan flames of inflation and would push stock prices temporarily higher, which we saw early on with the money that was handed out. And it could cause mortgage rates to rise further and also make the Fed's job of corralling inflation more difficult. The run off the Fed's balance sheet, basically the steps involved are, the first step is to stop purchasing new bonds and treasuries. The next step is to hike the federal funds rate. The Fed is still currently buying $70 billion a month in mortgage bonds and reinvestments, keeping rates low. If and when the Fed stops reinvestments, mortgage rates could move higher than previously thought. For a stock market forecast, I mean, we can kind of follow history repeating itself. Right now, stocks are expensive and price earnings multiples are high. Rate hikes could cause PE multiple contraction, resulting in lower stock prices as seen in the past. And, all in all, if it plays out as anticipated, we could, probably predict as much as somewhere around a 10% decline in the major indices and later on in 2022. The interest rate forecast, we anticipate mortgage rates to rise along with inflation during the first part of the year towards 3.75%, so anywhere from 3/8 to 0.5% higher than we currently sit. The federal funds, with the Fed action, softer stock market, and slowing economic conditions, interest rates should head lower in the second part of the year, down towards 3%. And potentially, retrace the lows that we've seen moving into the later part of 2022 or 2023. The forecast basically rates to rise the first half of the year and then decline towards 3% in the second half as the Fed hikes rates. Strategically, this sets up a bias of less upfront fees, which we've always preached, basically meaning, if you're going to do a refinance now, cash out refinance to consolidate debt, do so under the premise of not paying for closing costs. Get a slightly higher interest rate, knowing that there's an opportunity down the road to refinance into a lower rate, or potentially look at an ARM as an option to maintain a slightly lower rate, knowing that maybe a 30-year fixed at ARM rates today could be had in a year or so from now. Housing forecast. Housing will remain strong in 2022, but not as strong as 2021. Demand might be slightly softer due to rise in interest rates. So maybe earlier in the year, as rates increase, it could present a good buying opportunity if people get a little spooked and home prices level off or don't see the appreciation that's expected by the end of the year. Supply will increase but remain tight. Tight labor, supply chain disruptions, and semiconductor shortages will play a role. Rents will continue to rise. Increases will remain above 5%, pushing many people to see the benefit of buying. Basically, the forecast is mid to high single-digit appreciation, still providing a great wealth creation opportunity. And that's basically it. We just wanted to share with you our thoughts on what's taking place, what's happened, and how we've come to be in the situation that we are with higher inflation, but also more equity in our homes, how to use that to our advantage. Debt consolidation is probably a great tool for 2022. And then again, just reiterating, if it's refinance focused, that you're going to want to do so without paying fees or closing costs, knowing that there's a very strong likelihood of another opportunity a year or so down the road where we're going to see some lower rates again. Other than that, we hope you all are looking forward to an amazing year. If you have any questions or a specific situation, definitely reach out to either myself or Angel, and we're happy to help. And if you'd like to pass this along, please feel free to do so. Have a great 2022.